So my name is David Blain. I'm the partner in charge of the firm's Director of Entrepreneurial Services group. With me today is Mark Heath. Mark, say hi.
Good afternoon, everyone.
Here we are, Mark. This is our 5th webinar. It's almost like a car race. You know, we get around the corner and then there's a car wreck and then we have to stop the race and then we have to restart it again. That's what this has all been like, hasn't it?
I was wondering how you're going to fit a car crash in there.
Exactly. So again, I want to say thank you everybody for attending. Just a couple of housekeeping items here very quickly to start. There's a lot of people on this webinar. We have pretty close to 600 people on the webinar. Questions are coming in on a regular basis. We're going to try to get to your questions as quickly as possible. Bear with us as we go through this application process and how the application is working and some of the changes that we've noted from the application. We're going to go through that first. But anyways, we'll get to questions as quickly as possible. It's the webinar set for 90 minutes, and we're going to do the best we can. So there's some pictures of myself and of Mark. Mark's Director of Tax Services with the firm. I think everybody on here. A quick overview of the firm. Again, we have offices in McKonly Asbury. We have about 90 employees, offices in 3 locations, Lancaster, Camp Hill, and Bloomsburg. We provide a wide variety of services from accounting, advisory, attest, consulting, and tax. Right there, you can see the different industries that we're in: affordable housing, construction, and we do manufacturing, insurance, healthcare, nonprofits. Wide range of services within the firm. About 90 employees across 3 locations, serving most of Pennsylvania. So visit us if you want to know more. You can visit us at our website at macpas.com. Without further ado, moving forward here as we move into this, today we're going to talk about a couple things. Let's go back here a second. There we go. Oh, going too far ahead. Bear with us here a second. All right, let's just go back to the page. There we go. So we're going to cover a couple things here today. We're going to talk about the important clarifications that have come out with the application itself. So that's going to be covered here. There's a number of different things that have came out that are unique now with the application that we've noted that changed some thinking around the whole process and how the loan forgiveness works. We're going to also do a walkthrough of the application. There's going to be a hyperlink on here that you can go into the application on the SBA website. And Mark and I are going to walk through the application, what it looks like. It's an 11-page application and how it works. And then we put together a very quick example of how to fill the application out. And we're going to walk through that as well. And then at the very end, we're going to leave time open for questions and try to address as many questions as we can. All right. So, Mark, I wanted to, want to share this right here. I don't know if you were a big 1980s guy when it came to professional wrestling, but that was one of my favorite wrestlers, Roddy Piper. And, he used to have a thing called the Piper's Pit. And I kind of feel, Mark, like you and I are in the Piper's Pit. We kind of have our own, like almost Piper's Pit type of cast every week here as we talk about SBA. But Roddy Piper said something that kind of stuck with me when we think about this whole loan protection thing. And that was, he said, just when you think you have all the answers, I change the questions. And Mark, I kind of feel like we're in the same boat here. Just when we think we have a good handle on where we're at with the SBA and where we're at with loan forgiveness and the requirements around it, all of a sudden then you get new guidance. It's almost like after the fact guidance. So it's just a crazy situation. It continually changes. Even with the application, Mark, we've seen significant changes.
Yeah, I was always a big Jimmy the Superfly Snuka fan, but I can't come up with a quote from him that would top this.
But doesn't this quote not match exactly where we're at today with this whole?
It does. It absolutely does.
Yeah. So we're going to move on here. So Mark, why don't you talk a little bit more about some of the important clarifications that we ran into as this application came out on Friday evening?
Yeah. So as we've discussed in all the other webinars and articles, there was a ton of clarification that we needed on a bunch of different items. And it was a little frustrating that the SBA waited so long to give us these clarifications. For whatever reason, they waited that long. because we know they had the answers weeks ago. We knew how they were going to, we know that they knew how they were going to interpret this stuff, just for whatever reason. I don't know if there was internal fighting on how to do this or whatever, but we have them, we're here, so let's go over them. So the biggest thing, biggest theme of questions we got from people, and the biggest source of confusion was, and you'll notice that's in quotes, this line in the CARES Act that said, forgivable costs include costs incurred and payments made. As we said before, a very liberal reading of that said, if you incurred the cost or you paid for the cost during the period, during the covered period, then it would count. Other people, another interpretation, a more conservative interpretation of that was it had to be incurred and paid within the period. But then you kind of go back to the, well, if my first payroll that I pay within the period, that cost would have been incurred before the period. And so we kind of said, okay, let's kind of go with a hybrid here and say, if you paid it during the period and the cost incurred before the period, then you can count it. Or if the cost was incurred during the period, let's just make sure that even if that payment was going to be made after the period, why don't we just do a special payroll during the period to make sure that that gets covered. Well, fortunately, we got kind of the best of both worlds here. The SBA, as part of the application and in the instructions, they came out and said, this is going to be both costs incurred and payments made. So for payroll, if you paid the cost during the period, you get it. If you incurred the cost during the period, you get it. Same thing with the non-payroll costs, our rent payments, our mortgage interest, and our utilities. If you paid it during the period, that's great. If you incurred it during the period, that's great. Now, one important clarification for that is, first of all, the definition of what's paid for payroll. They specifically said employers are generally eligible for forgiveness for the payroll costs paid and payroll costs incurred during the covered period, like we said, and payroll costs are considered paid on the day that the paychecks are distributed or the date that the employer originates an ACH credit transaction. So the moment your payroll is funded, you're good if you're doing it electronically. The day that the paychecks are distributed, once they're put in the mail or made available for clients or for employees to come pick up, it's going to be considered paid on that day, no matter when the employee actually cashes the check. Now, as far as the incurred piece goes, they helped us out there because they said the payroll costs are considered incurred on the day that the employee's pay is earned. So if they worked the day, you're liable to pay them for it. It's incurred on that day. And finally, payroll costs incurred but not paid during the employer's last pay period of the covered period, regular or alternative, which we'll talk about later, are eligible for forgiveness if paid on or before the next regular payroll date. So we're going to talk about more about this in kind of details of the dates, but so the payroll that you pay, your first payroll during the period that you pay for payroll that was incurred before the period started, you're going to get that. You're going to be able to get forgiveness for that. Also, for your first payroll that falls after the payroll period or after the covered period, the portion of that that is for costs incurred during the covered period, you're going to get to include that even though you didn't pay it during the covered period. So what does that mean? That means we get to double dip on all of this. There was a lot of concern over having to run a special payroll. There's a lot of concern over we're not going to be able to fit all of our payrolls in here. They opened this up, and so there's no reason why you shouldn't be able to get all of your regular payrolls in for forgiveness during this period. Same concept applies for non-payroll costs. So if you paid a utility bill that was for utilities relating to before the covered period, if you pay it during the period, you're going to get that. and all of your utility and other costs incurred during the period, as long as they're paid in the first regular cycle, the first regular billing cycle that falls after the end of the covered period, you're going to get that portion that was incurred during the period as well for forgiveness. So they did, they gave us a lot of leeway here, and we feel kind of lucky, honestly, that they interpreted that way.
You know, Mark, it almost seems like what they did here is they redefined the definition of the 56-day, 8-week period, and basically said that if anything happens that you either paid it or incurred it during that period, you can pick it up, even if you happen to pay it after the period, as long as it happened, as long as some means of activity, whether paid or incurred, happened in that 56-day period. So they're still using the 56-day period, but your payment might be 60 days, 62 days. A good example might be that if your payroll was, if your 56th day of your loan is June 10th, but you do your next payroll on June 15th, you would actually get to pick up that 10 days of incurred within that time period, even though you don't pay it to June 15th.
Yeah, that's absolutely right, and that's what we were hoping for. This is kind of a good sign that the SBA listened. That because a lot of the complaints were, we're not quite sure how we're going to fit all this in here. I think they just listened and said, okay, we're gonna make this as inclusive as possible to make sure everybody gets the payroll and the stuff that we wanted these loans to be used for. We want to make sure that they're available to use for those things. And two, I think probably they heard feedback that if we can't get forgiveness for all this stuff, then we're going to say we're going to do whatever we can to try and get forgiveness for other stuff. So I think they probably said, hey, let's just open this up a little bit and make sure the costs or the money gets used for what we want it to be used for. So they took a liberal interpretation of it, which was very helpful.
Yeah, absolutely, Mark. I agree with you, especially too on not only on the payroll, but even on the non-payroll stuff like your utility bills. You know, everybody knows depending on what your contract is with PPL or whoever you use electric or whatever your utility, you kind of know what date those bills are coming and for what period they're for. So them giving you the ability to pick up the incurred piece as part of the forgiveness, as long as it's paid within the period of the bill, it really, when you think about it, just makes sense.
I agree.
Yeah.
So the next big clarification that we got was the comparison for the hourly and the hourly wage reduction test. When we first read the guidance, the interim final rules, and the law, it was very confusing because it said you had to compare what you paid an employee during the covered period to what you paid them during Q1. Q1 was 13 weeks. The covered period is only 8 weeks. And so the people started saying, does this mean I have to pay them the same amount? Most places were silent and said, well, we don't know. We have to wait for clarification on that. We kind of said from the beginning, hey, look, that's crazy. There's no way that's what their intention was. We feel very confident that they're going to come out and clarify. You know, every once in a while you get lucky, and they did. They came out and said in the instructions, everywhere you read anything about the salary and hourly wage reduction test, it refers to, and that's why these things are in quotes, average annual salary or average hourly wage. So you do not need to pay an individual the same amount during the covered period as you did during Q1. You don't have to give them a raise during this 8 weeks. All you have to do is make sure that their average annual salary didn't change and that their average hourly wage did not change. So someone who worked in Q1 making $50,000 a year, whatever that math is per week, that's what they got paid. As long as you pay them that same average rate, that same average annual salary during the 8 weeks, then you're good. So that was very helpful.
Yeah, agreed, Mark. And I think we were giving the guidance all along too, that it was probably based on average annual salary during those periods, because at the end of the day, that was the only thing that made sense that would actually work. There's no way you would take the first 3 months of payroll and say, okay, you got to match that in 8 weeks. It just didn't make any sense.
Exactly.
Yeah.
Next clarification they made for us was the average FTE test. we had been saying, and a lot of people had been saying, recommending using 30 hours. We kind of said you could use 30 or 40. They didn't clarify. They didn't tell us which to use yet. So we kind of went with the ACA and said, this is what's already in the law to define a full-time person. So we said 30 hours. They came out and said 40 hours. So so that's helpful. And that's kind of what everybody's used to anyway. Honestly, the ACA 30-hour week was kind of an anomaly because it was generally accepted that full-time was 40 hours a week. So for that average FTE test, again, you're just going to use 40 hours. Anybody who regularly works more than 40 hours, they're going to be a full FTE. Anybody who works less than 40 hours, you're going to do the math during the measurement period to say how many hours they worked, divide that by 40, or divide that by the number of weeks. If it's less than 40, you're going to get a fraction of an FTE. If it's 40 or more, you're going to get 1. And then you're going to add all those up and get your total FTEs. They did provide a simplified alternative, which may or may not help depending on what situation you're in. The simplified alternative is they say if you have an employee who works more than 40 hours a week, they're 1 FTE, which is the same. Then they said if you, for any other employee, if you want to say, we're just going to say all of our part-time employees, those who work less than 40 hours a week, we're just going to say they're 0.5 FTEs. You can do that. My guess is, well, and 2, you're going to have to do that across the board. They didn't say this, but you're not going to be able to pick and choose and say, well, this employee only worked, 10 hours a week, but we're going to say they're part-time and just use the simplified alternative and say they're a half FTE. But then this person over here, they regularly work 30 hours a week, so we're going to say that they're 75%, or whatever. We're going to say that they're more than 0.5. You can't pick and choose. It's either you do the calculation consistently for all your employees, or you use the simplified alternative for all of your employees. There's no way they're going to let you mix and match and get the best answer. But we are saying, you probably need to run this both ways. And you need to use it consistently for each measurement period. So during the covered period, you can't use one, and then for your other period that you're comparing it to, use a different test just because it's a better answer. We're thinking you have to use both, or use it consistently for both periods. But we are recommending, run it both ways, and whichever gets you the better answer. I'm guessing there's not that in most cases they'll be consistent, but maybe not. So just make sure you run it both ways to make sure that you meet your average FTE test.
Yeah, Mark, just to kind of piggyback on that too. I 100% agree, Mark, because when I was doing the example that we're going to be doing here later, you could have a situation that if you were to use the simplified method and assign 0.5 to a part-time employee versus using the full method where you're looking at how many hours they worked, what is the average amount of an FTE for the hours worked, you could end up putting yourself in a situation where you've now added 1 or 2 FTEs, or you're short 1 or 2 FTEs. So you do need to run it both ways, and then you need to be consistent with how you use it across the board. If you're going to use a simplified method, use it the whole way across the board. So. That's
right. And yeah, this is kind of the same as the 30-40 hour week. As long as you use it consistently, your answers probably aren't going to be that much different. But it is important to run it both ways to make sure that you're getting the best possible answer. Some more, these are even more than clarifications. These were additions. So you can still get full loan forgiveness even if you don't meet the FTE test if you had technically 4 scenarios which caused you to have a decrease in FTEs. So we received a lot of questions on this. What if an employee leaves? What if they refuse to come back? What if I have to fire them for any number of reasons? What if they just quit because they can't work, or they're afraid to work, or they have family members at home that they have to take care of? So they came out and said you can get an exception under the FTE reduction test if you made a written offer of employment at similar pay to the employee that they then turned down. So say before you got the loan, you had to lay everybody off, and then you got the loan, so you tried to get them back as an employee, and they refused to come back. As long as you sent them a written offer of an employment at a similar pay scale, you can't, offer them half pay to come back, at a similar pay to what they were making before, and they refuse it, then you can get an exception for that FTE. Again, written is important. Presumably email would be fine. Just make sure you document it. Like we've said with everything, if it's not documented, it didn't happen. So make sure you document it. If you fire someone for cause, this obviously firing someone for cause in any scenario is a very gray area. But if you're forced to fire someone for cause, make sure you document why you fired them. And this now goes into kind of labor law. But make sure that you have performance reviews, specific instances of insubordination, whatever it is. Make sure you have all that documented so that you can use that exception and not get penalized for going down on your FTEs. The other two are both voluntary on behalf of the employee. So if an employee voluntarily resigns from employment for whatever reason, that's not going to ding you on the FTE test. Or if they said, hey, I was full-time, I can only work 20 hours a week now for whatever reason, as long as that was voluntary on their behalf, you can get credit back up for that on the FTE test and not be hurt.
Okay.
So this was initially, when we first read this, this is kind of an exciting thing to accountants, which isn't saying much, but nonetheless, it was exciting. They offered up this alternative payroll covered period because everyone was having the same question. If I run my payroll every 2 weeks and I get my loan funded on a day that doesn't coincide with that payroll, this is going to be a nightmare trying to do this. I'm going to have to run a special payroll to make sure I get all my payroll included, et cetera, et cetera, et cetera. So they came out and said, we're going to offer borrowers this alternative payroll covered period. What this alternative payroll covered period says is, at the election of the borrower, if you have a biweekly or more frequent payroll schedule, you can elect to calculate eligible payroll costs using the 8-week period that begins on the first day of your first pay period following the loan disbursement date. So by doing this, you can basically just line up the covered period with your payroll periods. The thing here is in the instructions, it starts off by saying for administrative convenience. At the end of the day, I don't think this is going to be anything other than administrative convenience, because first thing, they said bi-weekly or more frequent. That's fine if you're paying employees every 2 weeks. If you're paying employees twice a week or twice a month, sorry, that is less than bi-weekly. So you don't qualify for this alternative payroll covered period. Because too, if you're paying employees twice a month, you're technically going to fall out of that 8-week, 56-day period. Because by definition, 2 months is more than 56 days. So it's not going to help you there. It is really just for administrative convenience. But when you combine that with the liberal interpretation of the costs incurred and payments made, it shouldn't be a problem for you. So this is just for administrative convenience. Do note, this is for payroll costs only. So it does not apply to the other non-payroll costs, does not apply to rent, does not apply to utilities, does not apply to mortgage interest. This only applies to payroll. And it must be used consistently in the application. So anywhere in the application where it talks about covered period as it relates to payroll costs, if you elect to use the alternative payroll covered period, you have to use it across the board for payroll anywhere in the application. You can't go back and forth.
Yeah, it's interesting. It's interesting that they put this in place. But it does give some clarification for those that are on biweekly payroll. A little bit more understanding of, you can elect to go to the first pay as your alternative pay period, and it at least lines everything up nicely, Mark, from a bi-weekly perspective. Because if you think about it, if in an 8-week period, that does make sense. It will make it more clear that you're going to get your 8 weeks of pay or your 4 pays in there.
Yeah, I agree too, and I think also it helps with the banks when they're reviewing the applications. Because if they didn't do this for everyone who runs payroll biweekly, you'd have to do some math there to prorate payments, to allocate payments outside of that fall outside the covered period. Instead, this way, you can just give them your payroll. If you're running payroll every 2 weeks, you just give them your payroll reports and everything should match up. So yeah, it really is just for administrative convenience, but it's helpful.
Yeah, Mark, and that's a good point too about the banks. I mean, I think some of the clarification that we're seeing here also is to give the banks a little bit more guidance or leeway in regards to how they're going to be looking at this and looking at the information. It's just to make sure they check the boxes and they've dotted the I's across the T's on loan forgiveness. Otherwise, they're going to get such a wide variety of different information. It's going to be hard for them to manage all that. So this at least gives a little bit more, it kind of boxes it in a little bit more, boxes it up in a more nice neat package.
That's right. So next thing that changed was there was kind of this question there, how do owners play into this? They came out and said, well, first of all, again, we'll go through in this more detail when we actually look at the application, but on the application, it breaks out cash compensation and non-cash compensation, and it breaks it out amongst employees who made more than $100,000 per year and owner employees. So they added this definition. Actually, they didn't add the definition. They just added this term, owner employee. Because they did not define it, we're left to assume that any employee who is also an owner of a business is caught up in this. So it doesn't matter if you own 1%, it doesn't matter if you own 100%. You're, in the absent future guidance, you're going to be deemed to be an owner employee, and your forgivable payroll costs are going to be capped at the lesser of 8 weeks worth of your 2019 compensation, or $15,385 per owner employee, which just happens to be $100,000 divided by 52 times 8. So why did they do this? We know exactly why they did it. There are a whole bunch of companies out there who they were going to pay all their payroll, and then at the end they were going to have this amount that is going to be left over that they couldn't get forgiveness for. They didn't want to pay it back to the government, so the owners were just going to say, I'm just going to bonus myself out the money, which that's fine. You can still do that. They've just decided you're not going to get forgiveness for it because they don't want it. This was not meant to enrich owners. This was obviously meant to keep people on payroll. Doesn't mean the owners shouldn't get paid. They should get paid, absolutely. But the intent of it was to make sure everyone is treated equitably and everybody gets paid as part of this program.
All right.
So what hasn't changed? This is just kind of a reminder of those key things that did not change as part of the application process. 75% must still be used for payroll. That hasn't changed. That's always going to be the case as far as we know. Although they did clarify it because there was a little bit, some people were interpreting it and saying must 75% of your total loan be used for payroll, or must 75% of just your forgivable costs be used for payroll. They did clarify by way of how they're doing the calculation that the 75% of your forgivable costs must be used for payroll, not 75% of the total loan. So if your total loan is $2 million, but you're only going to get forgiveness for $1 million, let's say, only $750,000 must be used for payroll or without getting dinged. So it's 75% of just the forgivable costs, not the total loan. FTE and salary and wage reduction tests, they're still in there. The FTE and salary wage restoration exceptions, they're still in there. They even gave us a little more room on that. That's where, as long as you restore salary and wage levels and FTE counts to what they were before you got the loan, as long as you do that by June 30th, you're going to qualify for the exception and be eligible for full forgiveness. The certification of need is still in there. You still need to sign and say, I needed this loan in order to continue operations. And they're still going to be reviewing loans exceeding $2 million. So none of that stuff has changed. Did I miss anything?
Yeah, the payroll thing, the clarification, that is something that was a question that we would get on a regular basis. Is it 75% of the full loan amount or 75% of the forgivable amount? So when we go through the application, you're going to see and note that yes, it is based upon the forgivable amount. and not just on the full loan amount. So that is something that is, like, they did give a little bit more guidance on that just because of the calculation, and a little bit more leeway, quite honestly, by saying it's 75% of the forgivable amount. So. All right, so I think we're on to, so for everybody, there's a hyperlink here that will take you right to the SBA form. So if you click into that, it'll take you right into the SBA website, and on the SBA website, you're going to see the forgiveness application. If you go down here to, the download here for the PDF, it's going to take you right into the form. Okay. So here in this form, what we're going to do, Mark and I are going to walk you through the form. Okay, it's 11 pages here. A lot of what Mark talked about is covered in a lot of these instructions here. And if in the 11 pages of this form, there's actually only 3 pages that are the actual form itself, or the document of the form itself. Everything else is instructions on how to complete it. As I said, Mark's covered a lot of the details already on what has changed that is going to impact this form. But what we're going to do is we're going to go through this form, walk through it, and then we're going to go through an example of completing this form. So the first thing I'm going to say, though, Mark, is this, is like, as we go through this form from page 1 to page 11, it actually is easier to go through it from page 11 to page 1, because you actually have to start with the sub-schedules to get to the top of the application schedule, and we're going to show that when we do our example. But for the purposes of what we're trying to do here, for simplicity, we're just going to take you down through what this application looks like in the event that you haven't had a chance to look at it yet. Talk about some of the key line items on the application, and then we'll go into our example. So on this
it's kind of like they're doing stuff backwards. Weird.
Yeah, how about it? Surprise, surprise, right? So this is the first page of the application, and this is a lot of definitions and instructions on how to complete the actual application itself that we're going to get to. It talks about putting in the basic information, your business name, address, what your loan number was, lender's loan number, what your PPP amount was for. Just a lot of information here. Couple things to note here is that they do ask for information on your EIDL loan. If you did get an EIDL loan, it does ask for the advance amount that you might have been advanced and what that application number is. As you look at the application itself, there and nowhere else in the whole application does that advance really matter, but they do ask for this information on the very basic page of the application. The other things too on here is it does talk about what Mark talked about a little earlier here. It goes over the clear definition of what the covered period is, talking about the 56-day, 8-week covered period, and it also talks about the alternative payroll covered period and how the alternative payroll covered period works. I'm not going to read that to you because Mark's already kind of gone through that in great detail, and what Mark talked about is exactly what you're going to see on this page for the covered period.
One thing I just want to point out there, I have no idea what this relates, but they make you say employees at time of forgiveness application and employees at time of when you applied for the loan. One thing to note, those are the total number of employees. That is not FTEs. There's a difference. Total number of employees doesn't matter if they're full-time, part-time. Each employee counts as one. So it's different from your FTE number. I don't know why they have those on there, other than, you know, they might just want the information for their information to have.
Yeah, Mark, you make a great point there, because it doesn't calculate into any of the calculations here. Everything is based upon FTEs. Every calculation that we're going to see in here is all based on FTEs. It has nothing to do with just headcount. So yeah, who knows why they want that on there, but that's what they're asking for.
Yep.
So as you page down here and you keep going here, the next set of instructions here talks about what each line of the application is for. So when we get to the actual application, the bottom part of the first page of the application lays out what each line is and defines what each line is. And it might be easier if we just actually go to those lines and move right through it instead of reading what the instructions actually say. So we're going to get to that page here in a second. As you get down here under summary of costs eligible for forgiveness, again, this is some clarification that Mark's already talked about in the webinar. And again, it's on page 2 here if you want more detail on what is eligible payroll cost and what is eligible non-payroll cost. Those items really haven't changed. What is eligible and what is non-eligible payroll cost? Nothing's changed in there in regards to what we've seen in the interim final rules that have come out. This is just putting it on the application so you can kind of see it. Plus, it also talks about the idea of payroll costs paid and payroll costs incurred, and the idea of that you can pick up those incurred costs in the paid period and so on and so forth. So this is where the meat of the application starts then. Again, you're going to see at the very top of the application, the first half of the application is going to be where you put the basic information of the business. You're talking about how much your loan amount was, your employee counts, any EIDL advance that you got, you need to put in there. The other thing too in here is that it asks you to identify your payroll schedule, whether it's weekly, bi-weekly, twice a month, or monthly. Again, that's going to be somewhat important for when you get to the next part there where it talks about the covered period. And there in that covered period, or the alternative payroll covered period, that's where you're going to elect what, if you're going to use the covered period, and the covered period being from the date you receive the dispersed monies for that 8-week period or 56 days, or you're going to use this alternative date, which is going to be your first payroll after you've received disbursements for 56 days. That's where you're going to identify what period you're going to use. And then the next box here is if borrower, together with affiliates, if applicable, receive the PPP loans in excess of $2 million. That's where you're going to check that box. I guess that's going to be their indication that if you receive more than $2 million, that you will be under audit by the SBA at some point in time. How that's going to work, I have no idea, Mark, but it'll be interesting for sure. So
it's already interesting.
Oh yeah, exactly. I agree. So down here in the bottom part of this application page, this is where you're going to go through the information that is going to be in these subschedules that are going to roll up into this front page. The first item is obviously payroll costs. We're going to get to a schedule in the back that is going to do the full calculation of how the payroll costs actually work. And that's going to roll up from that page onto this first line. The next couple items here are your non-payroll items. It's going to be your mortgage interest payments. It's going to be your rent, your leases. It's going to be your utility payments. The one thing, Mark, in the application that we're going to get to in the very end is that they do give more guidance and detail as to the exact documentation that they're looking for in regards to how you support your payroll costs, how you support your utilities and your rents and your mortgages. A lot of what you're going to see in what they're looking for documentation-wise, Mark, is no different than what we've already been talking about, but now it's giving you clear line of sight that when it comes to utilities, you have to have a utility bill for what you are paying, and you have to show the payment of the utility bill. Or if it's a rent and you have a rent agreement, you have to have the rent agreement showing what the rental payments are. If it's interest on covered debt, you have to be able to show what the interest was that you paid on that covered debt, not the principal, it's just the interest. But it does talk about what some of the detailed documentation is that you need. And that's where that's going to go up here under payroll and non-payroll costs for these first 4 line items. Then as you get down to line 5 here, there's going to be a calculation in the back that talks about salary and hourly wage reductions. This is where this is going to be subtracted off of your forgivable amount. And this calculation on this PPP Schedule A, line 3, is going to look at who in your employee base had a salary reduction that was that reduced them under their 75% threshold. That's where that loan forgiveness is going to get reduced, and it's going to show right here on the application in its reduction. Then we're going to take lines 1 through 4. We're going to add them together, multiply by line 5 to get this amount. Then there's going to be again in some of these subschedules, there's going to be this FTE reduction quotation, and this is where you're going to have to look at your FTEs by whatever the period was that you chose, Mark, which would have been if you chose that period between February 15th to June 30th of 2019. Or you chose the period of January 1 to February 29th of 2020, or if you're a seasonal employer you pick the 12-week period in between that time period that they laid out of May to September, that you picked out a 12-week time period in there. That's where this FTE quotation reduction is going to come into place, because you're going to look at your FTEs that you had during this 8-week period, and what that average was, whether you restored those FTEs by the end of the 8-week period or you restored them by June 30th. So there's going to be a number of different FTE calculations. And what I would recommend highly to everybody is, before you even get started with looking at this loan application, you should be going through the full FTE analysis first and foremost, because that's really going to be the big driver of everything on this application.
Yeah, I want to reiterate that we've talked about that in the past, but that's kind of a big deal, because if you fail the salary reduction test, you're going to lose some forgiveness, but it's a relatively small dollar amount, assuming it's not crazy below that 75% threshold. But the FTE piece, that is where you could really get dinged, particularly if you only have 20 employees and you lose 2 of them, your FTE number goes down by 2, you just lost 10% of your forgiveness. So that's the FTE one, is one you really need to track and make sure you have the appropriate documentation in place if you qualify for one of those exceptions.
Great. Yeah, so the interesting thing about this application is down here under lines 8, 9, 10, 11, because when you get down here, this is where you're going to look at what your loan amount was. You're going to look at what your 75% of payroll cost is, and that's line 10, where you're going to take line 1, which is your payroll cost. You're going to multiply it by you're going to divide it by 0.75 to come up with, this is what your forgivable balance is. And then you're going to look at this modified total. And the modified total is the total that could get you, Mark, because that's the one that looks at, you take this reduction in FTE quotation above, and you multiply it by what was the actual payroll and other non-payroll costs less whatever wage reduction you have. And if you have some quotation amount of like 0.9 or 0.8, that's going to have a significant impact on how much is forgivable, because the way this calculation works, Mark, is at the very end, you take the lower of the numbers between lines 8, 9, and 10, and that's your forgivable amount. So again, if you're not staying within your FTE counts, that could be really the bigger item that impacts you more than anything on this whole calculation.
Yep.
All right, so moving along here. The next page here is all the certifications. Again, this is very similar certifications that you already saw in the loan application process when you sign the loan application. It goes through all the same things, that the money that you used was for the forgivable purposes. You used them for this forgivable purposes. That the information that you're providing is accurate, complete. Because again, Mark, when you look at the requirements of this whole loan process, it's actually the onus is on the borrower, not on the bank, to identify the correct information. The banks aren't really required to do any auditing here. I think what it's going to come down to for the banks is, it's going to come down to, they're going to have to review it to make sure the information is there and it's complete, but they have no audit requirement to audit anything. But you, the borrower, have the onus to make sure that information that you're providing is accurate and complete, and that you want to make sure that that's accurate and complete, because just like we've talked about at the very start here, we don't know what's going to change in regards to requirements. 2 weeks from now, Mark, things could be completely different in regards to what the SBA says they're going to look at, or what the banks will look at. So again, it's important that you make sure that you provide the most accurate information to the bank. You got to keep in mind that these banks are looking at thousands of applications. It's going to be hard for them to get through loan forgiveness for an applicant if you don't give them the information almost complete and accurate, where they can just check the boxes and move on to get you your loan forgiveness.
Yeah, it's going to be in your best interest to make life at the bank as easy as possible. My guess is every bank is going to have a checklist that says, yep, they got it. Yep, they got it. They're just going to go down the list and check everything off. My guess is they're not going to be redoing your calculations, because they most likely don't have the time or the people power to do that. So I would, again, we've said it over and over and over again. Get in front of your bank, talk to your lender, find out what they need, find out what they'll accept, see if they'll give you a copy of a checklist, assuming they have one that they're going to be using to approve these loan forgiveness applications. See if you can get a copy of that ahead of time. So when it comes time to apply for loan forgiveness, you hand them a package and it says, here's each one of your questions, here's each one of your check boxes, here's our support for each one of these items, so that they can go through it in 5 minutes and just check everything off the list and be done.
Exactly. So, I mean, most of the certifications here are still the same. I think the important one is at the very end here is where a lot of the hype around, did I need the loan, and we're going to give this extension to pay it back. Again, you're going to have to certify there that you acknowledge and agree the SBA may request additional information for purposes of evaluating the borrower's eligibility for the PPP loan and loan forgiveness. So, one of the things that, we have been advising our clients is to make sure that at a minimum, you put together some type of memo or some type of documentation around the reasoning that you needed the loan, the economic impact that you had because of the COVID-19 pandemic and businesses being shut down. As long as you have, make sure you just have something of documentation of sorts in place that just kind of supports that, even though probably the likelihood they're going to ask for it is slim to none, but it's probably good that you do have it because you are certifying on here that you will be able to provide that documentation in the event the SBA did ask you. So again, just make sure you've dotted the I's across the T's and you put that information in place. Get down here and it's just going to be, again, the signature pages and everything. Now, what we're going to get to is more the meat of the application. The first thing is called the PPP Schedule A. And here on the PPP Schedule A is where we're going to talk about how the whole roll forward of the payroll costs work, whether in regards to the cash compensation that's paid, in regards to looking at the FTE worksheets, salary reductions, things like whatever other costs that you might have had that are payroll related, things like healthcare costs, contributions to your retirement plans, state and local taxes paid by the employer, separations, things of that nature. And it's going to roll all that forward and also look at the FTE calculation and quotation and how that works. So this page here again, this is the instructions on how this page actually works. And I'm not going to go through all the instructions and read line by line what each of these instructions are. We're going to go actually right to this document and take a look at it. The one thing I will tell you is if you look at this portion here called line 11, where it talks about the borrower's average weekly full-time equivalency during the reference periods, this goes back to what I was telling you before. The first and foremost thing I would highly recommend everybody do is look at what the definition is on line 11 here and go and calculate all those FTEs first before you even start this application, because you really need to have it in place. And there's multiple periods here you got to look at. You got to look at that. You got to look at that chosen period that we like to call it, whether it's the February to June time period of last year, the seasonal period, or the first 2 months of this year. But then you also got to look at some of the other headcount periods, such as what was your headcount on February 15th of this year? What was it, or FTE, what was your FTE count between February 15th to April 26th? What was your FTE count at the date during your 8-week covered period? What was it at June 30th? There's a number of different periods that you actually got to calculate FTEs inside of this application. So that would be the first and foremost thing I would tell everybody to do. So without further ado, let's keep moving along here. So this is what's called PPP Schedule A, and again, this is you're going to see how this rolls forward. The first item is going to be you enter all the cash compensation that was paid, and as we go through this, you're going to see a worksheet on how you look at everybody's cash compensation by employee and by those that were greater than $100,000. It's going to be on a separate worksheet that's been provided by the SBA. But you're going to look at all your cash compensation here in line 1, and then this goes to this FTE thing. Your average FTEs for the PPP Schedule A worksheet table 1. That's going to be what your average FTEs were during your 8-week covered period. Then the next thing is going to be there's going to be a wage and salary reduction calculator, and this is going to be for anybody who had wages that were reduced more than that 75% threshold, this is where you're going to see where you're going to have this reduction in your forgiveness based upon whatever that might look like. And that's going to be a calculation that's in here as well that we're going to get to here shortly. But what this is going to do is it's going to roll forward your cash compensation that was paid. And then you're also going to look here at anybody, this table 2 thing, this is going to be anybody who's greater than $100,000. You're going to add them in here as well and what that FTE count is. Down here then, as you go down further on this schedule, it's going to look at your non-cash compensation payroll costs. It's going to look at things like your health, like I was talking about, health insurance, employer retirement programs, state and local taxes. You're going to add that in there because that's all forgivable payroll costs in accordance with the interim final rules that came out. Now, the next line item 9, this is where Mark was talking a little earlier with everybody about employer-owned, self-employed individuals, general partners. This is where that information is going to go. It's not going to go up here under cash compensation paid to employers, or even where it's cash compensation that was paid to anybody with a salary greater than $100,000. Your owner's compensation is going to go in here. And correct me if I'm wrong here, Mark. One of the things that we didn't identify and note is that that we're only going to be picking up total at the end, and you said this earlier, only the cash compensation paid to the owners, and it's going to be the lesser of what was on your 2019 Schedule C for 8 weeks, or it's going to be the 15,835, which would be the equivalent of $100,000 over 8 weeks during a 52-week period, and it's not going to include health insurance contributions or anything else that an owner might take. It's going to only include cash compensation.
So actually, I think you can include the non-cash compensation as for owner employees, as long as that owner employee doesn't get a ratable amount up to $100,000 above that $15,000 number. I think you can. You kind of have to go through the mechanics of the calculation. You know, like you said, the cash compensation piece comes from the worksheets, and in those worksheets, you do not enter any cash compensation for owners. So then you come back here to this page, and the non-cash compensation section, lines 6, 7, and 8, that doesn't differentiate at all between owner employees or just employees. So I think you can include it on there, and then down on line 9, you would include the cash compensation. And I'm looking at it probably a little differently than you are. But then if you go to the certification section of the application, the first point, there's 4 bullet points under there. The 4th bullet point says nothing in these forgiveness amounts is greater than $15,385 for employee owners. So I mean, I feel like you can, as long as you don't get up over that $15,000 number for owner employees. Or at least I should say, I don't see anything in the application or in the instructions that says you can't. I think it's just whatever the number is, it's capped at that $15,385 for owner employees.
Yeah, that's a good point, Mark. I mean, you would think that you could probably pick, because if it's in the health insurance, it's in the health insurance, right? As long as the cash compensation to the employer or the owner is limited to that 2019 Schedule C amount, lesser of that, or the 15,000.
Yeah, now you have to be careful, because if you put in that non-cash compensation payroll costs section, you can't just put the number that's on the bottom of the invoice there, because you're going to have to see how much of that relates to owner employees to make sure you're not going over that 15,385 number. Because again, it's specifically on page 4 of the application. The first certification is the dollar amount for which forgiveness is requested, and then the 4th bullet point does not exceed 8 weeks worth of 2019 compensation, and it does not differentiate. It doesn't say cash compensation. It doesn't say non-cash compensation. It just says it just says compensation, which leads us to believe that it's total compensation. So you cannot request forgiveness for anything more than $15,385 for an owner employee, per owner employee.
Yeah, exactly. So basically, again, I guess what I was trying to get to is the fact that whatever you do with the health insurance, we'll use that as an example because that's usually the biggest item for owners. You're going to have to make sure that that health insurance, when you look at it from your total compensation, having to pick the lesser of what was on your Schedule C or the 15,385, that you're not actually double dipping there where you have, let's say your comp was greater than 100,000. It's 15,385. You can't pick up 15,385 plus the health insurance that was attributable to you as well. You're limited to the 15,385.
Right, because before all the guidance, it seemed perfectly fine that health insurance and non-cash compensation could take you over the $100,000 for any individual employee when annualized, and we think you still can as long as that employee is not also an owner.
Yeah, exactly. So that's the big item right here that you're going to have to pay attention to on the compensation to the owners is here on line 9. And then what's going to happen is all these numbers are going to roll down here, and it's going to give you what your payroll costs are. So you're going to add all the numbers above, and it's going to on line 10, and it's going to give you what your payroll costs. Now, the next big item is this right here, and there's going to be a calculation on this as well. This is where we talk about the FTE reduction calculation. And again, I can't reiterate enough that you got to spend time on the FTE calculations first and foremost, because it's all over this application. And it's the one that can have the biggest impact on your forgiveness more than the salary reduction, because at least the salary reduction, Mark, is dollar for dollar, right? This FTE is a quotation reduction. So if let's say you had 10 employees and at the end of the forgivable period had 9, your forgiveness goes down by 10%.
Yep. Yeah, this is one you cannot just skip over this one. You have to make sure you meet this one.
Right. And that's where down here is all these calculations that talk about what your average FTEs were during the borrower's chosen reference period. And again, we all know what the chosen reference period is. It's that February to June 2019 period. It's a seasonal period, it could be, or it could be that January, February 2020 period. And then it looks at what your average FTEs were during your 8-week period. That's where it says add lines 2 and 5, that you're going to be putting that up at the top of the application. And then you're going to look at whatever the difference there is going to drive this FTE reduction quotation. Now, obviously, if you've maintained the headcount from the start to the finish, it isn't going to be an issue for you. But if you did a situation where you had layoffs at the very start and you're bringing these people back, you're going to have to really pay attention to what that average FTE is going to look like during that 8-week period versus whatever covered period you picked. And I think the important thing here to talk about too is, and we've hit this 100 times, but it's worth hitting one more time, is clearly you want to pick the covered period that has the lowest amount of FTE, because that's going to make sure when you look at this equation that if whatever reduction in the FTE you might have had, it's going to give you a lower quotation difference.
Yeah, you're saying for the denominator, you want to choose the lower number, whether that February to June period from 2019 or January and February of 2020. You want to pick whichever one's lower. That's going to help your calculation.
Yeah, you're 100% right, Mark. Thanks for giving better clarification on that, but Mark's exactly right. So we're going to go down here now. Now there's another worksheet behind this, which is called the Schedule A worksheet. The Schedule A worksheet, as you can see, here's a table of instructions on it, and it's going to go through on the Schedule A worksheet all the basic information on what cash compensation is and how you define it. It's going to talk about what defines an average FTE. As you can see here on this average FTE, this is where, as we talked about earlier, it gives you this simplified method where anybody who's salaried that's 40 hours or more, or any even hourly employees that are 40 hours or more, you can use a 1 as their FTE. Anything under that 40-hour mark, that's where you can use the simplified method of saying that they're half FTE, or you can go through the full calculation of figuring out how many FTEs do they equivalent into if they were only 30 hours a week. But anyways, it gives you that ability to use that simplified approach. Down here at the bottom is an interesting little calculation on this wage reduction, wage and hourly wage reduction. So, while it's not specifically in the worksheet that we're going to go to next, they do have this calculation down here. And when you read the document initially, it says that for every employee, you're supposed to go through this calculation. But then when you read into this section here, it says for employees that you actually reduce their wages, you would want to do this calculation. Everybody else should be fine. So this calculation looks at, it's going to look at first what was the average annual salary or hourly wages during the covered period for that person that you reduced their wages. You're going to look at then what the average salary was between January 1 and March 31. Again, going back to what Mark talked about before, where we got the clarification on what was considered average annual wage. And the whole intent here is what they're trying to figure out is that did you restore their salary costs? And if you didn't restore their salary costs, now let's go through the calculation of trying to figure out what the add back needs to be against the loan forgiveness. So that's what step 1 does here. Step 2 then is the safe harbor, and this is where you're going to look at the annual salary at February 15th, and you're going to also look at what the average annual salary was from February 15th to April 26th. And they're saying here that if you maintained or you were able to bring those wages back to what they were at February 15th, then you're within that safe harbor limit, and therefore there is no reduction to your loan forgiveness. So you might not have paid them the same amount through the whole time period, but as long as you've restored their wages back to what their wages need to be at the end of the forgiveness period, then you're going to be in this safe harbor period, and therefore you won't have an impact to your loan forgiveness amount. So that's what these calculations are, and this is where you're going to want to look at this for anybody that you know that you've reduced either their hours or their compensation during the period of February 15th to April 26th, or anytime during the forgiveness period. You're going to want to go through this calculation for those individuals. We're going to go through this a little bit in detail too when we get to the example, but that's what that calculation is. That calculation then expands back over to here, where you're looking at it based upon if you're looking at it, their hourly or their salary, but that's where this works too as well. So then there's some more definitions down here about what the FTE reduction and safe harbor is and what the FTE reduction exceptions are. And as Mark talked about earlier, in one of the clarifying points was this FTE exception reduction, and that's where you're going to be talking about people that you gave an employment offer of good faith to have them come back, and they either A, didn't want to come back, or you had to terminate them for cause, or there was some type of voluntary termination. Then as long as you have the right documentation in place, you can qualify for this FTE reduction exception. All right, so almost there. Everybody bear with us here as we get down to the very end here on the application. So now we get to what's called this PPP Schedule A worksheet. And this is where you're going to, this is actually a pretty simple document of all the ones that we looked at, because this is where you're going to put this is where you're going to calculate the name of the employees' names, how much cash compensation did you pay to them during the covered period, what is their average FTE? Are they greater than 40 hours a week? They're 1 FTE. If they're not, or you're going to use a simplified method of 0.5, or are you going to use some other blended rate based upon how many hours they worked. And then anybody who had compensation that was reduced during the time period, that's where you're going to put their salary reduction in here, over here on these cells over here. The next table here then looks at anybody's greater than $100,000. And if you're greater than $100,000, it's just, you know, you're going to use the cash compensation, which is pretty much going to be $15,385, and they're going to be 1 FTE most likely. As you can see, there's this salary or hourly reduction column here because they've already maxed out, so there wouldn't be any salary or hourly reduction there. They're going to be at $15,385. Down here at the bottom then is the FTE reduction safe harbor calculation. This is what we're talking about with the reduction safe harbor, being that if you had people that were terminated or for cause, or there was something in there that was related to they just didn't want to come back to work or something like that. So that's where you're going to get this safe harbor calculation that you're going to be able to calculate and put into the main part of the application. So as we go down through the bottom here, the very end is just information on, this is optional too. We didn't even talk about this. This is optional. It's demographic information that they're looking for. Why they're looking for it, who knows, but it's information that is there. Before you go any further here, the page before that, this is where I was talking about a little earlier. This now gives you a little bit more guidance in detail on the list of documents that the banks are going to be looking for. And so there's a little bit more guidance, a little bit more detail on what payroll documents are they looking for, what FTE calculations are they looking for, and what type of documentation are they looking for in regards to the non-payroll information, utilities, rents, and all that kind of good stuff. So that's kind of a run through of the application. A lot there. It's 11 pages, a lot of instruction. Tried to run everybody through what we know are the changes in the application, what are also, how does the application work. The one thing I'm going to tell you now is that it's easier to do this application from the back forward because everything works up to the front. So having the worksheet done at the very start of what you paid cash compensation from your payroll reports, using that because that's going to drive the Schedule A, and then the Schedule A is going to drive what goes on to the application itself. So it's easier to work from the back forward on this application, but this is the application in and of itself at this point in time. So with that said, we are going to go to, we're going to go here now. We're going to look at a completed example, and we tried to keep this example very simple and not make it too overly complicated. So in this example, we're going to use just that the organization has 3 full-time employees and 1 part-time employee. Employee count remained the same up to the start of the pandemic. Part-time employee was temporarily furloughed on effective March 15th. This company received a PPP loan on the 20th for $65,000, and they pay bi-weekly payroll, and they chose the alternate payroll period. So their payroll period is April 26th to June 2020. So the first thing is, again, I'm going to go back to this, and I'm going to hit this again because I can't say it enough. Start with figuring out your full-time equivalents, and you need to look at the chosen period, your chosen reference period, and you need to look at the safe harbor calculation. Okay, they're the 2 most important FTE calculations in here, and it drives everything and the quotations that are all through this application. The average annual salary or wages, you're going to need to look at this for the time periods of January 1 to March 31. So you're going to want to know what that average annual salary is. You're going to also want to know what it is on February 15th. So you're going to want to look at what that was, if that was a pay period or what that might have been on that date. You're going to also want to look at it from February 15th to April 26th, and you're going to want to look at it on June 30th. Again, these are all dates that are throughout the application. And the reason why I'm saying I would start here, because if you do all this and you do all these calculations up front, it's going to make doing the application itself relatively easy. If you start on the application, you start trying to work through it, you're going to find out, I got to get this, I got to get this. You might as well start here, pull this documentation together first and foremost. It's going to drive all your calculations. All right. So what I did here is, for simplicity purposes, what we did here first and foremost is we looked at what was our chosen reference period. And basically what we said here in this calculation is we're not a seasonal employer, so we're going to look at the reference period of either this February 15th to June 30th of 19, or we're going to look at January 2020 to February 29th, 2020. So in this application, what we're saying is we had two full-time employees last year. This year we have 3. Our part-time employee worked 375 hours during that period last year. They worked 240 this year, so it's pretty similar. And at the end of the day, our FTE count was 2.5, and the current period is 3.7. So clearly, in this calculation, we're going to want to use the 2.5. It's the lower number. It's going to be the lower denominator number, which is going to help us out when it comes to meeting the quotation of the FTEs. Next, then, we went and said, okay, knowing that we're going to have to calculate all these safe harbor calculations for these different time periods, we need to look at what those FTE counts were during those time periods as well. So that February 15th to April 26th is a time period that's throughout the document. Knowing what that FTE count is, and what that average annual salary cost is during that time period is also important. So we did that calculation here, assuming that we kept those 3 full-time employees and our part-time employee had 80 hours during that period. So we're saying they had 80 hours because we remember earlier we said that this person was furloughed on March 15th. If you look at it on February 15th, that's another key date in this whole document, is we had 3 employees. The part-time employee had 59 hours, so that head count or FTE count was about 3.7. Then, assuming that we get to June 30th, we're looking forward thinking here. Assuming we get to June 30th, that's also another date that's throughout this document, and therefore we're saying in that during that time period, that part-time person had 50 hours. We kept the 3 people full-time. So pretty much at the end of the day, our head count or FTE count, I keep saying head count, but I mean FTE count, is relatively similar between the 3.2 to the 3.7 during that time period. Again, whole key here is that you spend the time up front calculating the FTEs and calculating the average salary cost during these periods, because it drives the majority of the calculations. What we're saying here next is, again, it's easier to work from the back of the application forward. It's better to start with the worksheet at the very back, the worksheets tables A and B, and drop in your FTE counts and your payroll numbers from there and move forward, versus trying to start from the forward working back. So here is this is now Schedule A worksheet. So on the Schedule A worksheet, what we've identified is we've identified our three employees. 2 were part-time. 2 are full-time. Daryl and John. Kristen's a part-time employee. And in this scenario, we're going to be showing, and I'm going to show you the calculation here, where Kristen has a salary reduction that's going to be impacted in the actual calculation in and of itself. Down here below then, we're showing one employee named Diane, who Diane has got compensation that's greater than $100,000 average annual salary during the year. So we're using $15,835, and she's considered 1 FTE.
Just not for nothing, Dave. It's actually 15,385, not 15,835. Okay,
yep. Sorry about that.
Yeah. Dave's not very good with numbers.
Thanks, Mark. Thanks for the clarification. So this page here talks about the we're going to look at the one employee, Kristen, who ended up having a salary reduction, and this kind of goes through this whole calculation of how this salary reduction worked. And this again goes back to what I was saying, understanding what these average annual salary costs were during those different periods is going to be very important, because it's going to drive all these calculations. So you're going to need to know that information. But if you look at step 1 here, it talks about what was her average annual salary cost during the covered period. And in this instance, we're saying it was 31.2. We're saying it went down because she had a portion of time that she was furloughed and wasn't able to come back. And then when she did come back, we're saying that not all of her hours are able to be restored. Her average annual salary, though, when you looked at it from January to March, is $48,000. So what does that mean? That means that it drove a difference, or it drove this this value of 0.65. So if that value was 0.75 or more, we would have considered that, you know, she's in the safe harbor. Even though her salary might have went down, she still had compensation that was 75% or greater. We would be able to not have to do the remainder of this calculation pretty much. But in this instance, we're saying no, compensation went down. We have to go on to step 2, which step 2 now looks at this safe harbor calculation. It says, look at what her annual salary was on February 15th. So here we're saying it was 50. It was close to that 48, but it was 50 on the 15th. The reason why it's a little bit lower is because, remember, we furloughed her on March 15th, and that impacted this number here above by a couple $1,000s. We then have to look at what was her average annual salary during that period of April 26th through or February 15th, April 26th. Here we're saying that, you know, we brought her back, but when we brought her back at a much more limited salary. So that's why she was at $24,000. You get down here, then it says the average annual salary as of June 30th. So here we're saying looking looking forward ahead here, we're saying that we got to June 30th, and her average annual salary at that point in time, when you looked at it, was $45,000. So we do these safe harbor calculations to get down to step 3. So step 3 basically says, what was 75% of what her average annual salary was during the first quarter? Well, it's 36,000 of the 48,000. 36,000 versus what was actually paid, what her actual average annual salary during the covered period is 31.2. So that's what's driving then your reduction. So we're saying that, okay, her average annual salary actually was reduced by $4,800. So if I'm being reduced by $4,800, what does that actually mean in regards to loan forgiveness? What we're going to do is go down here then to the very bottom of this calculation, which looks at, we're going to assume that she's salary, not hourly. That's why I'm saying there's no hourly comp here. We're going to go down here to this calculation. It says to take line 3B, which is the 4,800, multiply it by 8, okay? And then you're going to divide it by 52. So why are we multiplying it by 8? Because it's 8 weeks. We're going to divide it by 52 because it's taken into account the whole situation of a whole year. And that's where we get this salary reduction calculation of $738, and that's what goes up to the front pages that we saw, or to the back page when it looked at the wage reduction. So we're saying that Kristen has a wage reduction of $738. That's going to impact our calculation. All right. So moving on, further on that page, we talked about earlier was the safe harbor reduction FTEs. This is where the calculations that I showed you earlier then go on to this page, and we'll drive these calculations for these very same periods that we just talked about with the wage count. Again, you might as well start there. Start with making sure you look at these periods and get those numbers pulled together first and foremost, because it's pretty much the drivers of the whole calculation at this point. This is then leads up to the actual PPP Schedule A, and this is where you're going to look at your total compensation. It's going to come from the worksheets, 30,000. It pulls down your head count or FTE, and then it pulls down what that wage reduction was, which was just 738. It also looks at your second table, which is the 15,000 that we saw for Diane, being that she was maxed out on her compensation, and that what her FTE count is. Further on that page, it's going to look at, again, the non-cash compensation. Here we're saying it was $5,000 for health insurance, $1,000 for retirement plans. And once you add all that up, you come up with total payroll costs of $51,835. In this example, we're assuming that there was no employer or a self-employed, individual employed payroll compensation. But if you had that, you would put that in here as well at this number right here. All right. Now, as we get further on this Schedule A, there's this FTE reduction calculation. So here's where you're going to look at what was my FTE calculation during that chosen period. What was my total average FTE during the period, the covered period that we are in. In this instance, because we had a higher count than we had during the covered period that we chose, we stay within this FTE equivalency calculation, which means we're not going to have anything from a reduction that's going to impact our forgiveness at this point. So therefore, we're going to use 1, saying that we met the safe harbor calculation. If for some reason this number here under average FTE was like 4, and your average FTE during the time period of this calculation was 3.5, that's where you're going to have then a number here, or a percentage here, that's going to carry up to the front. It's going to be the quotation number that's going to impact what your forgivable amount is. So then this all rolls up to the very front page of the loan application. We see the payroll costs, the mortgage interest, the rent, utilities picked up. You're going to add all that up, and then you're going to subtract out that $738 for the wage reduction that we saw that Kristen had. And what that's going to do is it's going to drive the fact that you have $64,097 that is a forgivable amount. Note here, this quotation is 1 because we calculated that we stayed within the FTE count. if for some reason this is like 0.8, we're going to take that 69,000, we're going to multiply it by 0.8, and that's going to give us then what the forgivable amount is. Why is that important? Well, it's important because when you go to the back page, the very end of the application, it says you got to take the lesser of either the modified total, which I showed you earlier, the PPP loan amount, or the payroll cost, which is 75% of dividing line 1. You have to actually take the lower number there, and the lower number is the forgivable amount. So in our instance, our forgivable amount is $64,097. Our loan amount was for $65,000. So that means in this example, we have $903 that is that needs to be repaid or needs to be refinanced or needs to be financed over the 2-year period. So that's a very quick summary calculation of how this application actually works. Everybody's calculation is going to be different. Everybody's scenarios are going to be different. But this is kind of a quick summary of how it quickly works. Mark, should we look at some questions? Now that we've still got 10 or 15 minutes here.
I believe we should. So we got a whole bunch of questions before the webinar, and we got a bunch of questions during the webinar. We're going to try to get through as many of these as we can. So, and also I want to say we get that this is very complicated. And just from seeing a webinar, reading the application, it's going to be complicated on how to do all of this stuff. We're here to help. Do not hesitate to email us, whether the COVID-19 inbox or one of us directly, your questions. We're here to help with the actual calculations and with the preparation of the application. Just reach out to us. We are happy to assist however we can. So first question. Someone kind of asked a general question, the FTE reduction, and it looks fairly straightforward. Are there any pitfalls with this? No, it is a pretty straightforward calculation. The only pitfall is not tracking it, because it's very easy to kind of lose track of how many people are working how many hours. And we run into that issue too of if people aren't working, how many hours did they work? You kind of have to back into that number based on how much you actually paid them. And again, in a lot of these scenarios, you can just if you're going to lose loan forgiveness, just pay your people more. So you need to be tracking it during the 8-week period, not just when it comes time to do the loan application. Track it during the period, and if you're getting close to the end and you think you're going to have to pay some back to the government and you don't want to do that, you can pay your people more to get around that. You know, it's bonuses are okay in this thing as long as it's kind of in the normal flow of business and you document it. We don't see any problem with that. And also afterwards, you can always make sure you restore everybody back to their hourly wage or their annual salary before June 30th to get full loan forgiveness, or at least be eligible for full loan forgiveness as long as everything else is covered. We got a couple questions on prepaying expenses. We don't see anything in the bill or anything that allows you to prepay expenses. So we would recommend not prepaying expenses. The way that's going to work with the incurred and paid definition is, you know, even if you make a payment during the period, you're going to have an invoice to support that. So if you just arbitrarily pay 3 months worth of rent during the covered period and then say, well, what are you talking about? It's rent, it's covered. If that's not in the normal course of business, or in the case of a utility, if you don't have an invoice to support that, that worries me a little bit. So we would not recommend prepaying. We would just make sure you pay a good faith effort to say, here's what our costs incurred during the period, here's what we paid during the period, and here's what we paid in the first pay cycle after the period ended for costs that were incurred during the period. So self-funded insurance plans. I had a couple questions on this. Presumably, and Dave, jump in here because you're a little more in this world than I am. On self-funded insurance plans, you know, presumably there's kind of that stopgap piece of insurance that you're paying to a third party, that would definitely be includable, assuming it's paid by the employer. And then any claims, I would think, that are falling during the period that you're paying out of the self-funded plan would qualify in there as well. Outside of that, I'm not sure what other piece there would be that you would be able to include, unless you have something, Dave.
No, I would agree with you, Mark. I don't know what else you would include there. I just don't have any other thoughts on that. I mean, you're right about that.
So let's say we're going to start going through a bunch of these kind of rapid fire here.
I mean, Mark, we're getting like numerous questions here.
I was just going to say we were doing okay. And then as soon as we stopped talking, like they just started rolling in.
So maybe we'll try to get through as many as we can here in the next 10 minutes or so. But I think, Mark, maybe what we should do is do what we did in the previous webinar, which is we'll take the questions, and then we'll do an FAQ on the questions and put them up on the website early next week, so everybody will have access to them. But we'll try to get through as many as we can at this point. A lot of questions I'm seeing, Mark, seem to be similar to ones we've addressed in the past. So I'm sure that we can get those questions answered pretty quickly. So, but let's kind of just keep going through here and see if there's anything that is unique that we want to talk about real quick.
So, and one thing I did want to comment on, there's been talk about the HEROES Act that was passed by the House. There's just no way that that's going to pass the Senate in its current form. There's a bunch of things in there, proposals to extend things, to allow for this, that, and the other thing. We're not addressing any of those because we don't want to give people hope and have them focus on something that may not become reality. If and when it becomes reality, then we'll make sure we get a good understanding of it. But since we have zero confidence that that's going to pass the Senate in its current form, we're focusing on what the law is right now to make sure everybody keeps their eye on the ball and doesn't start straying out on the things that may not become reality.
Yeah, you're 100% right, Mark. I mean, we want to focus on what we know. We don't know what that is yet, and I'm sure that that's going to go through a number of different iterations before it even passes. So, Mark, I'm looking at a question here. It says, does each FTE need to be the same person at the end of the period as at the beginning, or can some of them be newly hired employees? So the answer there is they can be newly hired employees. It doesn't need to be the same FTE. The fact is that we're looking at calculating what the FTE counts are, and that you've had the similar FTE count at the start of the period as you had at the end of the period.
Yep. Here's a question. Is the borrower allowed to pay rent for an affiliated company? So I would go back to this one and say, what does your loan application say? If company A and company B meet the definition of affiliated companies, and by definition, then only the company A and company B would have to apply together for the loan, and the amount of the loan was based on the numbers of combined company A and company B, then you would be deemed to be kind of the same borrower in this sense, and presumably you could pay rent for either one. If you are separate companies and you were permitted to apply separately for loans because your ownership or control was not common enough to count as an affiliated company, probably not. What they would say is, no, company B needed to go out and apply for their own loan to cover their own costs by themselves.
Mark, there's a question in here. It says, if I have a pay period, if I pay bi-monthly, which is the 15th and the 30th, I cannot do the alternative pay period. That would be correct. The alternative pay period would only be for if you are bi-weekly. Or some other more frequent payment type of period. It would not be for if you're 15th, 30th, or if you paid monthly.
That's right. So that's why I was saying the alternative covered period, I don't think it's that big of a deal. I really just think it's just makes the math easier if you're paying your employees every 2 weeks or every week or more frequent than that.
Isn't there a safe harbor on the certification that loans under $2 million remain in good faith? I want to say there's what we know is that I don't know if there's an actual safe harbor per se. What there is that we know the SBA is not going to be looking specifically at loans less than $2 million. But remember, though, in this certification here that you make on the second page of the application, it does still give the SBA a little guidance or leeway that they could come back and ask you for information regarding your need for the loan. So if you're under $2 million, you're probably safe, but you should be also aware that you still should have the right documentation in place to make sure that for some reason the rules don't change down the road, which we've seen here, and that you have the right documentation.
Yeah, actually, I think in that last FAQ that the SBA released, they did say that anybody below, I'm trying to pull it up now, they did say that anyone below 2 million, it would be deemed as if they got the loan in good faith. Doesn't mean they're not going to review you for your calculations, which is why they kept it. Doesn't say in terms of the getting the loan in good faith if you're less than 2 million, that does not appear anywhere on the application. I think it's just in that one FAQ that was released by the SBA and the Treasury. But again, they're leaving the door open to ask for information. So they still might review. It's just that I think that one question is going to be ticked off as okay, but they still leave the door open to review your calculations and everything else.
Here's a question about the payroll. Can it be more than 75% of the forgivable amount? Yes. Again, the whole intent of the act and the program is that they want you to spend the money really on payroll. So if you had more than 75% related to payroll, you would be fine there.
Yeah, here's another question along those lines. The payroll can only cover maximum of 8 weeks of pay during the period, correct? That was kind of a generally held principle, I'll say, just because, you know, they made the covered period 8 weeks, but there's nothing anywhere that says that. And because they expanded that definition of incurred and paid, I don't see why you wouldn't be able to pay more than 8 weeks. And at the end of the day, I think they're fine with that. I think they're fine with you paying a little bit of extra payroll because, again, the intent of the act was to go as payroll to get cash in the hands of employees. So we have hit 3:30 here. So to respect everybody's time, I think we're going to cut this off. But again, as Dave said, we will be preparing answers to all of these FAQs, and we'll get them up on the website along with the recording of this webinar and the slides as soon as possible. And again, if a lot of these questions have been addressed in previous webinars, so in the essence of time, if you want to get your answer now, you can probably go to our previous FAQ and pull down that and see if your question's on there already. So thank you very much, everyone, for joining us. Dave, thank you. And again, everybody, we're here to help. Email us. We can help you with calculations. We can help you with the forgiveness application, completing that, and we can just help you with all your questions. So don't hesitate to reach out. Thank you for joining us.
Yeah, and one last and final item I would say is more likely than not, we're going to see additional changes that will come from the SBA. And as those changes come, we'll continue to update our website and look for further webinars from us as more information becomes available and more guidance is out there. But again, as Mark said, thank you very much for your time, and we will answer these questions as quickly as possible. Thank you very much, and we will see you at a later webinar.